Welcome to This Explainer. Today, we're stepping away from the traditional, old-school world of picking stocks based on a gut feeling. Instead, we're diving into the fascinating, high-stakes realm of quantitative finance. This is the place where blind hope basically goes to die, and mathematical certainty takes over. So here is our quick roadmap for today's Explainer. First, we'll look at systems over human emotion. Then, passive investing versus active quants. Third, the math of the market. Fourth, winning in any direction. And finally, we'll wrap up with the Aspiring Quants Toolkit. All right, let's jump right into Section 1, Systems over Human Emotion. Get a load of this staggering statistic from SEBI, the market regulators. 93% of retail traders, meaning everyday people like you and me trading in options and futures, lose money. And honestly, the vast majority of the folks who do make a profit don't even beat a basic, boring fixed deposit savings account. Why is that? Well, it's because traditional trading is fundamentally driven by fear, greed, and hope. A stock goes down, panic sets in, and they sell at a massive loss. Or even worse, a stock goes down, blind hope kicks in, and they just refuse to sell, sitting there while their entire capital gets completely wiped out. It's like playing in a casino without any kind of system. Think about it, using this brilliant analogy from one of our sources. They compare traditional traders to ancient kings from the fictional kingdom of Undor. These old kings lived totally recklessly, spending everything on blind hope without a plan, which obviously led to their downfall. But the quantitative trader, they're like King Sami. When Sami took the throne, he didn't rely on hope or guesswork. Absolutely not. He demanded total clarity of his numbers. He lived below his means, mapped out every single resource, and built this rigorous 5-year systematic plan that slowly compounded to build an incredible new kingdom of wealth. Quants operate exactly like King Sami. They rely on a strict system, not a fleeting feeling. And this really shows how the financial industry has completely transformed over the decades. Back in the 1970s, trading was all about the hunch. Literally calling up your broker because you just had a good feeling about a stock. By the 1990s, these legendary traders known as market wizards started bringing in basic statistics, probabilities, and firm risk management. But today, in the 2020s, it is an automated machine. We're talking high-frequency trading systems firing off thousands of orders a second, AI models predicting market trends, and Python scripts scanning wild alternative data, like credit card transactions or even satellite images. Moving right along to Section 2, Passive Investing versus Active Quants. So let's look at the playing field. On one side, you've got mutual funds. These are passive, massive investment pools for everyday people. They take money from thousands of regular folks and buy giant baskets of assets, usually just passively tracking a big index like the S&P 500. They aren't trying to outsmart the market, they're just riding the wave, kind of like a massive, slow-moving cruise ship. But on the exact opposite side, we have hedge funds. Think Jane Street, Bridgewater, Citadel. These guys are active, aggressive, and highly restricted, moving through the water like a high-speed racing boat. You usually need millions of dollars just to get an invitation to invest, and they charge steep fees, typically 2% of total assets and 20% of the profits, because they deploy teams of elite quants to actively beat the market. Now, the absolutely crucial thing to understand is how these elite funds amplify their returns. They use a tool called leverage. Think of leverage like a mechanical gear that just supercharges a trade. Instead of only using their own cash, these funds borrow massive amounts of money. So if they want to buy a $100 million company or asset, they might only put down $20 million of their own money and borrow the remaining $80 million. If that asset goes up in value, their profit on that initial $20 million is absolutely astronomical. But of course, if things go south, the risk is equally amplified. It's high stakes. To manage those massive risks and place incredibly precise bets, quants use what we call derivatives. These are complex financial contracts, things you've probably heard of, like options, futures, and swaps. Here's a super simple analogy. Imagine being able to bet on whether it's going to rain tomorrow, but without actually having to own the clouds. That is exactly what a derivative does. It lets quants bet on the future price of a stock, currency, or commodity. They also use them as a shield to hedge against losses, all without buying the actual underlying asset outright. For example, buying a put option is basically just buying insurance. It locks in a guaranteed sell price, shielding the quant from catastrophic losses if a stock unexpectedly completely crashes. Okay, on to Section 3, the math of the market. If you just look at a daily stock chart, it honestly looks like a jagged, totally random mountain range. But quants, they don't look at absolute prices. They look at returns, which is just the percentage change in price from one day to the next. Now, if you take all those daily percentage changes for a single stock over a year and stack them up in a histogram, a kind of magical pattern emerges. Almost every single time, it forms a shape you might remember from high school math, the normal distribution, or the bell curve. Suddenly, the total chaos of the stock market perfectly fits onto a smooth, highly predictable mathematical probability curve. And this perfectly illustrates how pure statistics translate directly into high finance. That bell curve we just talked about, it's defined by just two numbers. The exact center of the curve, which is the mean in stats, is what finance pros call the expected return. It's simply how much money you expect the stock to make. And the width of the curve, the standard deviation, represents how wildly the stock swings from day to day. In the finance world, we just call that risk. By mapping out these exact variables, quants use an elegant process called mean variance optimization. It's a math technique that searches through literally thousands of combinations of stocks. It looks at the expected return of each one, maps out the risk, and, this is key, it looks at correlation, meaning how much do these stocks move up or down together. A Python script can crunch 125,000 correlation values for 500 different stocks in a matter of seconds. It calculates the exact percentage of capital to put into each asset to build a portfolio that maximizes profit while mathematically minimizing the risk. It's brilliant. Next up, Section 4, winning in any direction. So the foundational mechanism for winning when things go down is called short selling. Most of us buy a stock hoping the price goes up so we can sell it for a profit, right? Well, quants just reverse the timeline. They borrow shares from someone else and sell them immediately at today's high price. Then they hold onto that cash and they wait. When the stock price plummets, they buy those exact same shares back at the new, much cheaper price, return the shares to the original lender, and simply pocket the difference. It is the absolute ultimate tool for profiting off a declining asset. Let's actually tie this all together with a classic systematic move called a pair trade. This uses short selling to perfectly hedge market risks. Imagine we have two tech companies. Let's call them Alpha and Omega. Our math models tell us that Alpha is a fundamentally stronger company than Omega. So, step 1, we short sell $1,000 worth of the weaker stock, Omega. Step 2, we take that $1,000 in cash we just got from the short sale and immediately use it to buy $1,000 worth of the stronger stock, Alpha. Notice what just happened there? We haven't spent a single dollar of our own money to set this entire thing up. Now let's look at the outcome 3 months later. Let's say the whole stock market crashes, just totally tanks. Both of our stocks lose value. You would think we lost money, right? Actually, no. Because Alpha was a stronger company, it only dropped 10%, but Omega, the weaker company we shorted, dropped 12.5%. Because the stock we shorted fell more than the stock we bought, we actually walk away with a net profit of $25. See, quants don't care about the absolute price of the stock market. They literally only care about the relative percentage returns between carefully modeled pairs. But to execute this without letting human fear ruin everything, they rely on ironclad rules. Systematic trader Arjun Tandon highlights this perfectly. His algorithms have a hard-coded stop-loss rule. If the market goes wildly against his positions, the machine automatically cuts the trades, ensuring he loses no more than exactly 1% of his capital on any given day. He doesn't sit at the screen sweating, hoping the stock will bounce back. He cuts the loss immediately at 1%. The machine enforces the strict discipline that the human mind is usually just too weak to maintain. And finally, Section 5, the Aspiring Quants Toolkit. The cool thing is, you don't need a fancy Wall Street office to do this anymore, but you do need an entirely new set of technical skills. First and foremost, Python coding. You absolutely need to be able to write scripts that can process massive amounts of data. Second, you need to understand brokers' APIs, like the Kite API from Zerodha. This acts as the middleman, allowing your Python code to talk directly to the stock exchange without you ever needing to click a mouse. Third, you've got to study statistics and probability, understanding standard deviations, mean reversion, and correlation. Finally, you take those academic foundations, combine them with your coding, and build algorithmic strategies based on real historical data. And what do those strategies actually look like in action? Well, they can be as simple as writing a script that tracks basic technical indicators. For example, you could program an algorithm to constantly monitor a supertrend indicator, which measures market volatility and direction. Your code simply says, hey, when the price of silver crosses above the supertrend line, buy instantly. When it crosses below, sell instantly. The algorithm executes this rule flawlessly, thousands of times over, without ever getting greedy or fearful. Which brings us to the end of our explainer today. The financial markets have fundamentally changed. We've moved away from the days of blind guesses and entered a completely new era of mathematical certainty. The machines are already out there, treating millions of times a second, stripping all human emotion out of the equation to maximize returns and strictly minimize risks. So I want to leave you with this question to ponder. As you navigate your own financial future, are you putting in the work to build a reliable system? Or are you just trading on hope? Thanks for joining me on this explainer. I really hope this sparked your curiosity to go out there and learn more.